The price of gold down today as the conflict in the Middle East escalates. Here to explain why precious metals are seeing some pressure is John Ing, CEO at Maison Placements Canada. Thanks for joining us today.
Good to be here.
So gold typically where investors go to for a safe haven, but right now that's not the case. Why do you think that is?
Well, the old brokerage adage that you buy on mystery and you sell on history. And what's happened, of course, is we've known sometime the war drums have been beating. And gold has moved up. And so when the event happened, when the bombs were dropped, gold sold off. So it's a normal reaction. We must remember that gold has had a tremendous performance in the last couple of years. So this little move is not unexpected.
Okay. We know that gold shipments would have stalled in the Middle East as well. And I know that's a hub for Europe. Would that be a factor at all today?
No, I don't think that it's a big factor. It might be hourly and that. No, gold is traded internationally. The markets are both physical as well as derivatives. There is, for the last little while, there's been big buying of gold, as we know, basically because there's a tremendous amount of uncertainty. And my expectation is that the uncertainty will continue. We heard an earlier speaker talk about the planes. Well, there's prices. There's uncertainty about LNG, about oil. And this is what there's another old expression that gold is a barometer of anxiety. And there certainly is a lot of anxiety around. So my expectation is for gold to power ahead.
Yeah, you mentioned there's been a lot of buying from central banks being part of that, a big part of that, all of last year, something like 27 tons on average every month in 2025. But it's tapered off at the start of the year. And I'm wondering if you expect this year to be very different for central bank buying.
I think that central banks will continue to be buyers. What's moving them in the last 3 years have been concern about the U.S. dollar and the geopolitical climate. China has been a consistent buyer, and although their purchases have fell off in the last quarter, Poland, for example, has increased. So my expectation is that central banks will continue to buy for the fourth consecutive year. Because of the geopolitical uncertainty, and more important, there is a desire to boost gold in their bank reserves, in the central bank reserves. Gold now makes up the second largest reserve after the U.S. dollar. So, in fact, I think there's a lot of switching from dollars into gold, which is denominated in dollars.
Okay. I do want to get to some of the stocks you like in gold. Agnico Eagle, of course, a big Canadian company, and that's one of your top picks. What do you like about them?
Well, it's a Canadian company. The reality is that their profit margin is robust, but it's boosted by the fact that they get U.S. dollars and the Canadian price is, in fact, even higher. They have been managing their costs well, and the company has grown organically. My expectation is that they'll continue to do well.
So, John, when you see some of these companies that have done really well with that run up in the price of gold, would you still buy in where they are today?
There's no question that gold stocks are more popular today. But when you look around, gold stocks have been actually laggard in comparison to bullion. And usually they outperform bullion over time by 3 to 4 times. My expectation is that gold shares have become very critical. They are not making gold. We're not finding very many gold deposits, notwithstanding the fact that PDAC, everybody hopes that they have a gold mine. The reality is that we have very little gold coming on stream, and we have big demand. Sovereign banks, jewelry demand, retail demand, and now we have even cryptocurrencies buying gold. So my belief is that the gold stocks are actually very cheap here. They don't have a lot of debt. They have great balance sheets. They're returning some of that cash flow to shareholders. So I'm looking at them as growth vehicles.
Okay, let's talk about Barrick Mining. It's another one of your top picks. They've been going through quite a transition, as you know, and had a lot of problems in Mali. Why do you like Barrick Mining right now?
Well, Barrick is a favorite, principally because of their assets. They have the largest array of tier one assets. What that means is these are long life, quality, low cost mines. They have a new discovery in Nevada, which may or may not be part of this Nevada joint venture. Barrick is changing. In the next little while, I think the Barrick that we will be looking at will be Barrick built on growth. I think that they'll have growth in reserves, which is key here. And they got a great balance sheet now. In addition, they produce copper. So my expectation is that while a lot of analysts, investors have beat up on Barrick, I think that Barrick has performed well, will be an outperformer.
Is this a new top pick for you, or have you been a traditional supporter of Barrick? Or are you seeing now that there's more speculation and analysis from the inside that you think they'll evolve coming through this?
Well, there's an activist investor, Elliott, for example, and they got aboard basically because Barrick was cheap relative to a lot of the other gold miners. And my belief is that the assets will always carry Barrick onward. So we have John Thornton now he is the executive chairman. They have a new president, getting a new management team. And my belief is that the spinoff, whatever shape it will be accretive. But they also have a lot of assets elsewhere that is producing good cash flow, and they just can't replace them anymore. Barrick has very good management, and that's why I like the stock.
All right, John, I got to leave it there, sir, but appreciate you joining us today on the show. John Ing is CEO at Maison Placements Canada.